Tech is much sexier, but I still want to start with you, Greg, because you are a bank bull, but you note that you are a bank bull like when it made a lot more sense. And I think you're not quite as excited at this point. I'm talking about in the summer when you were anticipating a reopening trade with the banks. And now we've already seen it. They were so cheap back then. Are they still cheap, or do you just keep what you have?
Right. Well, we're not in the crazy valuation days that we were in pre-election, Joe. And that's right. You remember me talking about this over the summer, that the election would focus people on 2021 earnings. And we saw that trade, right? The indexes are up 50% since November. Select names are up 50% since November. It's now a stock picker's game. The sector is about to have some pretty significant tailwinds, but it won't lift all boats equally. The sector bet is done. What I'm looking for in particular is the large diversified names that were able to aggressively provision on the back of robust trading businesses, on the back of robust capital markets. Those are the names that will benefit disproportionately as we start to enter a real cycle. Now, the headwinds will be that we haven't seen the net charge-offs yet, and that net interest margin rate may remain compressed. And off of the last recession, it took 10 years to get above 2%. But we saw credit normalize first, and I think we'll see that again. Again, we've seen some pretty significant releases last quarter. J.P. Morgan released 2.9. Bank of America released almost $1 billion. And so I think, again, those will be tailwinds. I'd stay in those large diversified names.
Paul, let's get over to tech. Yesterday, we started seeing, I guess, maybe a glimpse of the future and what tech looks like in a higher interest rate environment. If there's any sector that really loves low interest rates, extended low interest rates, obviously it's tech. And it took Powell in the middle of the day and those comments to sort of have tech rebound. But your point is it's got nothing to do with the actual fundamentals of each company. It's kind of a macro view for when tech goes down like that. But isn't it something to be concerned with if rates continue to go higher?
Yeah, Joe, this is reminiscent of Chairman Powell's comments back in October of 18, where he talked about potentially starting a slew of rate raises. And the NASDAQ 100, the QQQ, in the next couple of weeks dropped 23%. That's a full-fledged bear market in just a couple of weeks. So I am bullish on tech fundamentals. Since we had that episode, here comes COVID. Terrible pandemic, but it's forced the world to digitize even faster. So fundamentals are strong. We've just come out of a real successful quarterly reporting period and guidance for most tech companies. So fundamentally, we're clean, Joe. But I do worry about comments coming from the Fed. And if we do have rates rising and they get out of control, I mean, this is the discount factor or the denominator in a discounted cash flow valuation. And just as you said, for growth stocks, it really impairs valuation. I would probably, if I'm a tech investor thinking about getting bigger, or somebody that's not in, that's thinking about getting in, let's hold back a couple of sessions, a couple of weeks, and let's see how these rates play out and the more comments from the Fed. We got some good news yesterday. But remember, this can be real evil for tech real fast. And I'd like people to stand back unless you're really a long-term investor.
Shepard Smith here. Thanks for watching CNBC on YouTube.